Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Caocao Inc. annual report. Caocao Inc., a ride-hailing platform based in China, offers various services to cater to the growing demand for mobility solutions. At its core, the company operates as a ride-hailing service, providing users with access to a fleet of purpose-built vehicles. In addition to its primary business, Caocao Inc. also engages in vehicle leasing and sales. This diversification into related services allows the company to expand its revenue streams and increase its market presence. By offering these complementary services, Caocao Inc. is well-positioned to meet the evolving needs of its customers and stay competitive in the rapidly growing Chinese ride-hailing market. The company's focus on mobility operations and vehicle-related services has enabled it to establish a strong foundation for growth and expansion. With its headquarters in Suzhou, China, Caocao Inc. is strategically positioned to capitalize on the country's vast and dynamic market. Caocao Inc. maintains a market capitalization of 16 billion, broadly in line with the industry peer group. Caocao Inc. trades at a lower price-to-book ratio of -3.41 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 277% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, increased gross transaction value, GTV, and rise in average monthly active users have been significant contributors to revenue expansion. The company's strategic decision to expand into new cities has also led to substantial growth. Furthermore, enhanced market share through refined operations and standardized services has played a crucial role in driving revenue upwards. Additionally, the strong reputation and brand effect of the company have contributed to its success. Specifically, mobility services have seen a 36.8% growth due to geographic expansion, user traffic from aggregation platforms, and improved user satisfaction and loyalty. Similarly, vehicle sales have experienced a 63.6% growth due to improved sales system efficiency and strategic expansion into new cities. On the other hand, revenue decline has been driven by certain factors. The reduction in vehicle leasing scale as older models were replaced has led to a 7.4% decline in others category. This indicates that while the company is experiencing overall growth, there are still areas where it needs to focus on improving its operations and services to maintain momentum. The net income of the company experienced a significant decline of 50.8% between 2024 and 2025, dropping from RMB 1,246.4 million to RMB 613.6 million. This substantial decrease in net income can be attributed to various factors. On one hand, the improved unit economics of the ride-hailing service due to its transition to fully unmanned operations contributed positively to the company's financials. However, this positive impact was overshadowed by other factors that led to a decline in net income. The strategic acquisitions made by the company, although contributing to revenue growth, also resulted in increased costs of sales. As a result, the cost of sales grew at a faster pace than revenue, ultimately leading to a decrease in net income. In contrast to the decline in net income, the gross profit margin of the company experienced an increase of 1.3 percentage points between 2024 and 2025, rising from 8.1% to 9.4%. This improvement in gross profit margin can be attributed to the strategic acquisitions made by the company, which helped to outpace cost of sales growth and drive revenue expansion. The company is indeed generating positive operating cash flow. This can be seen in the net cash generated from operating activities, which shows a consistent increase over the years. On page 1 of the financial report, the company's net cash generated from operating activities was RMB 378,254. This figure remains steady on pages 16 and 24, indicating that the company has maintained its positive operating cash flow throughout these periods. However, it is worth noting that there are discrepancies in the figures provided for certain years. On page 31, the net cash generated from operating activities is reported as RMB 834,331 for 2025 and RMB 716,748 for 2024. This suggests that the company's operating cash flow has increased significantly over the past year. Despite these fluctuations, the overall trend indicates that the company is generating positive operating cash flow, which is a promising sign for its financial health. The company's debt level and interest expenses have undergone significant changes over the past year. While the total indebtedness has decreased by 21%, indicating a reduction in overall borrowing, the non-current portion of borrowings has increased by 22%. This suggests that although the company is paying off some debts, it is also taking on new ones with varying interest rates. In terms of interest expenses, finance costs have decreased by 15.1% from RMB 317.1 million to RMB 169.2 million. However, this decrease is offset by an increase in interest expenses due to new borrowing agreements with higher interest rates. Despite this, the total interest paid for borrowings has decreased significantly from RMB 322,396 to RMB 271,890. Overall, while there are mixed signals, it appears that the company's debt level and interest expenses have changed significantly over the past year. The company's performance was marked by several notable successes across various segments. The domestic market stood out, with the deployment of 92nd-generation robotaxi vehicles contributing significantly to its success. Additionally, lower-tier cities within the domestic region also performed well, indicating a strong presence in these areas. Furthermore, the enterprise services segment demonstrated impressive growth, underscoring the company's ability to cater to business needs effectively. While there were no specific regions or segments that underperformed, international markets and regions presented opportunities for future expansion and growth. These areas hold promise for the company's continued development and success in the global market. Management is expressing a positive outlook for the company's future prospects. The key strategies outlined include optimizing growth by balancing speed with profitability, expanding into international markets, and focusing on lower-tier cities in China. The company plans to deploy more advanced robotaxis, including third-generation L4 vehicles, which will support long-term revenue growth and market share gains. In terms of specific initiatives, management is prioritizing strategic acquisitions to enhance enterprise service capabilities and expand the corporate customer base. Additionally, the company aims to satisfy its liquidity requirements through a combination of operating cash, ABS arrangements, bank borrowings, and unutilized credit facilities. Overall, management's strategy appears to be centered on driving growth while maintaining profitability, with a focus on expanding into new markets and investing in advanced technologies to support long-term success. That concludes the financial summary for Caocao Inc. Feel free to comment below, and I will be happy to answer them when possible.